Improving the presentation of net periodic pension cost and net periodic benefit cost. My name is Louise Santa Cruz, and joining me is Emily He. We are both members of the pension topic team in KPMG's Department of Professional Practice. Welcome to our discussion about the FASB's recent amendments to the presentation of net periodic pension cost and net periodic post-retirement benefit cost. We'll refer to these costs in the aggregate as net benefit cost. Over the next few minutes, Emily and I will talk about ASU 2017-07. We'll also talk about transition and the FASB's practical expedient for transition.
Louise, the scope of these amendments seems pretty narrow. Can you give us a little bit background about why the FASB issued this ASU?
Sure. So the FASB actually discusses the objectives of the ASU and its basis for conclusions and why it believes the changes improve the presentation of net benefit cost. But overall, the FASB is aiming to increase transparency for users by disaggregating the service cost from the other components of net benefit cost. We'll talk about this in detail in a few minutes. So stakeholders told the FASB that the different components of net benefit cost have different predictive values, and it can be difficult and costly for financial statement users, such as investors, creditors, and donors, to analyze the components using the current presentation.
That's interesting. Also, from what I understand, more and more companies are recognizing actual gains and losses immediately in the income statement. Stakeholders say this causes more volatility in line items that typically include net benefit costs like cost of sales and SG&A. So interim measures of performance like gross profit and operating income can be affected with reduced predictive value. The FASB aims to address volatility in operating profit by requiring that companies to present all of the components except one, service cost, outside income from operations, if reported. This seems to get back to your earlier point, Louis, about the FASB's aim to improve the predictive value through disaggregating the components of net benefit cost and presenting them separately in the income statement. Louis, now that I understand a little bit about why the FASB took on the project, can you explain how the financial statement presentation of net benefit cost will change?
So basically, companies will now present service costs separately from other components of net benefit costs, such as interest cost, amortization of prior service cost, and expected return on plan assets.
Did the FASB say why it separated service cost?
Yes, the ASU's basis for conclusion states that service cost is the one component of net benefit cost that exclusively originates from employee services during the current period, and could potentially have a significantly different effect in terms of predictive value of the reported information.
Back to improving predictive value. Do the amendments prescribe the line items where a company would present the different components?
They do. A company would present the service cost component in the same line items as other compensation costs. For most companies, this would be cost of goods sold or SG&A. Other components would be presented separately from service cost in the income statement, and interestingly, as we said before, outside income from operations if the company presents a subtotal. Entities that don't present a subtotal of operating income can decide where to present the other components, but they still need to be presented separately from service cost, and if separate line items are used, they need to be appropriately described. Also, Emily, only service costs are eligible for capitalization.
Sounds like that could be a big change for some company.
It could be, and as you can see now, the changes to presentation could affect performance measures. So now that I gave you more detail about the presentation change, Emily, do you see how the FASB intends the changes to improve presentation?
Yes, Louise. When is ASU effective?
For public companies, it's effective in 2018 and 2019 for all other companies. And public companies can early adopt as of January 1, 2017, as long as they haven't issued their first quarter interim financial statements. All other entities can early adopt as of January 1, 2016, as long as they haven't issued interim or annual financial statements for 2016.
Wait, so that means that a public company will need to decide really quickly whether it wants to early adopt, considering a calendar year company needs to issue its 10Q in May. How will the transition work?
Well, it's actually a hybrid transition. So companies would apply the amendments to the income statement retrospectively and the balance sheet prospectively. But to help companies transition, the ASU provides a practical expedient that makes it easier to retrospectively apply it for comparative periods. Companies can use the amounts disclosed in the pension and other retirement benefit plan notes to determine the service cost and other components of net benefit cost to present in the income statement in prior periods. I take a look at KPMG's defining issue 1708 for a good example of how the practical expedient works and more information about transition.
So, Louis, based on what we have been talking about, what do you think companies should think about?
So the first thing they need to think about is whether they're going to early adopt. Then, like any time there's new authoritative guidance, the ASU could affect a company's internal controls, especially around systems and processes that may need to change, the effect on reports on which management rely, and the management review controls. Also, since we said this may affect performance metrics, I'd expect companies to consider looking at agreements with employees, like bonuses, to see if and how the changes in presentation could affect those calculations.
What about disclosures? For example, actual gains and losses related to pension and OPEB that are amortized out of AOCI aren't capitalized anymore and need to be reclassified to net income in their entirety, which a company will need to disclose under comprehensive income accounting guidance. And I could imagine this would affect other disclosures, like segment reporting disclosures could be affected if a company reports income from operations for segments, such as reconciliation to consolidate amounts. I'm sure there are others, so probably companies should start thinking broadly about this.
True, and you know what else companies may want to think about? Whether the carrying amount of certain assets, like inventory or self-constructed assets, could change if only service cost is now eligible for capitalization. And banks will want to consider any retirement costs that they capitalize and deferred acquisition costs and loan origination costs.
Yeah, that's a good point. Speaking of capitalization, we need to consider industry-specific issues. For example, rate-regulated companies, not-for-profit entities, or defense or government contractors. Changes to capitalized costs could affect their expenses and revenue recognition. You know what else I just realized? The amendments will more closely align with IFRS, which also disaggregates service costs. However, there will still be differences because, for example, under US GAAP, actual gains and losses are recycled to net income, whereas under IFRS, they're not. And earlier we said that on transition, a company would apply the amendments to the income statement retrospectively and the balance sheet prospectively. Will that be difficult to calculate? For example, doesn't the company need to consider what amounts were capitalized in prior periods to determine the amounts to present in the income statement for comparative periods? That sounds like a lot of work.
Yes, it does sound like a lot of work. And actually, we believe that companies won't need to separate amounts they capitalized in periods prior to adoption. A company that elects the practical expedient can choose to depreciate and amortize those legacy costs into operating income. But this may affect comparability until all the legacy costs run through the income statement in future periods. So, Emily, I think you've raised some good questions today, and make sure to read KPMG's defining issue 1708. It's got a very good summary of the ASU, examples, and things companies should think about when transitioning to the new standard. So, Emily, thanks for joining me today to talk about the ASU 2017-07, and thanks to everyone listening.
It's a pleasure. Thank you.